Hey traders, welcome back. Today, we will talk about supply and demand zones, the most interesting and important topic. These are spots where big players like banks do their trading. But remember, I'm not a bank. We'll keep it simple and just call them supply and demand zones instead of order blocks or institutional blocks. These are places where banks are thought to buy or sell in the market. In this video, I will show you how to find these zones on a diagram by mentoring you through and how they can help your trading. Now, let's take a look at a bullish market. As you've learned from the first session on market structure, we need to identify the key highs and lows. Look at this diagram. First, let's mark the highs and lows using blue to make it easier on your eyes. As you can see, we've broken the previous structure, which I've indicated with an arrow right here. This occurs just before the significant move to the upside, leading to the formation of a higher high. The demand zone is located at the higher low. This area is our next point of interest for potential market opportunities. Now let's go through the criteria for identifying supply and demand zones. The first criterion is a break of structure. The second is a significant move up or down, and the third is an imbalance. You already know what a break of structure is from our market structure session. A significant move, which reflects price behavior, and imbalances are also familiar concepts. A break of structure is essential because it gives us insight into the market's direction and what the market makers are targeting. For instance, if we consistently see higher highs and higher lows, it indicates a bullish market. This means institutions or banks are driving the market upwards until we eventually see a break to the downside. A significant move, whether up or down, signals strong volume or a substantial push in price, which helps us identify potential supply and demand zone. Now let's focus on what happens when the market pulls back, making lower lows and lower highs. Once it reaches a specific location, let's call it a 4-hour demand zone. The market often starts to print higher highs and higher lows. Let's focus on identifying this demand zone. You can call it a point of interest, area of interest, or location. These terms are interchangeable and refer to the same concept. The same principles apply to a bearish market. If the market is printing lower lows and lower highs, your point of interest, or supply zone, will be at the first lower high. As the market prints these highs and lows, it eventually reaches our supply area before falling again, confirming the bearish trend. Notice how I've marked the lows and highs with the same blue color, and then see how it is leading up to the supply zone, and then see how it falls from the zone. In a bearish market, the supply zone is where you can sell. It's also called a supply zone, point of interest, area of interest, or location. Like in the bullish trend we discussed earlier, it's important to notice the break of structure, which I've marked in the same way here. Trading isn't a quick way to get rich. It takes time and learning, so don't become overly confident too soon. This is just the beginning of your trading journey. In the next video, we'll look at real chart examples. Remember, while trading may seem easy on diagrams, it's actually quite complex. But with consistency, you can succeed. Good luck, and enjoy the content. Bye for now.